Hi, good evening, everybody. I'd like to thank each one of you for joining us today for this very important plenary titled Catalyzing Commercial Capital for Impact is Blended Finance the Way. It is my pleasure to invite the esteemed panel for this session today. The session will be moderated by Ms. Bettina Prato, Senior Coordinator SAFIN, and the panelists include Ms. Geeta Goyal, Country Director, Michael and Susan Dell Foundation, Mr. Arindam Datta, Executive Director, Rural and Development Banking Advisory, Rabobank, Mr. Anil Kumar SG, Founder and CEO, Samunati, and Ms. Eleanor Keppelman, Director, Social Enterprise Finance, US IDFC. We would request all the participants to please share their questions in the Q&A chat box and also respond to the poll questions that we have for this session. And we look forward to a very exciting session. With this, Bettina, I hand over the charge to you.
Thank you so much, Priyamvada, and good afternoon to all who are connected for this session on Catalyzing Commercial Capital for Impact. Is Blended Finance the Way? As said, my name is Bettina Prato, and I coordinate the Smallholder and Agri-SME Finance and Investment Network, otherwise known as SAFIN, which is a group of about 50 institutions that work globally in different parts of the Agri-SME Finance ecosystem. It's headquartered in Rome, Italy, where I'm connecting from today, at the International Fund for Agricultural Development. I was really pleased to receive the invitation to chair this panel today because blended finance has been a topic of major interest for our network in the past few years, with a particular focus on food and agriculture, but also more broadly. Yesterday, I had the opportunity to listen to some of the sessions in the program of the summit, and I was really impressed at the pace and also the breadth of innovations in inclusive finance, particularly around technology-enabled finance, but also finance for tech-enabled business models across sectors. And I heard quite a bit across sessions about the need to also invest more in innovating in our risk management tool in terms of financial risk management tools, but also risk management more broadly. And I think this is clearly very important to really, as one of the speakers yesterday put it, to crack open this market of low-income households, rural society, micro, small, and medium enterprises, and other financially underserved or excluded categories of actors in India. So blended finance is potentially a really important part of this toolbox in financial de-risking. And it is also a domain of practice that is drawing more and more attention among development finance providers, donors, governments, but also impact investors, social lenders, and commercial investors as well. As probably many of you know, there are different definitions of blended finance. Perhaps the most well-known are those by the OECD, by the Convergence Blended Finance Network, and also the International Financial Institution community. What all the definitions share is an understanding of blending as a structuring mechanism for different types of capital to come together in ways that de-risk commercial capital or that enhance transactions that would otherwise not offer an attractive risk-return profile to commercial or return-oriented investors. And in recent years, the profile of blended finance in global conversations about development finance has grown greatly because, of course, of the realization that we are not going to achieve the sustainable development goals in the absence of A, the mobilization of large pools of commercial capital, and B, the alignment of all pools of commercial capital towards or around a sustainable development agenda. So India, as we also heard and were reminded earlier today and yesterday, is in many ways, or has in many ways, a very dynamic financial ecosystem, as well as a dynamic economy, But with many other countries, India shares this challenge of directing more commercial finance towards sectors that have high impact in terms of sustainable development, but where propositions in terms of risk-return profile need to be enhanced. Indeed, I was looking again at the global report on the global stage of blended finance by Convergence issued just this year. And India appears to be the second country in terms of number of transactions in blended finance over the past year, and as well as between 2018 and 2020. But the scale of needs or commercial opportunities and the scale of blending are really wide apart as yet. So what we will discuss with this panel is how to go to scale in terms of the utilization of blended finance to really crack open these particular high development potential, but also high risk or low commercial returns markets, and how to reconcile going to scale with keeping a focus on inclusion, as this summit is entirely dedicated to inclusive finance. So as we go into the questions to the panelists, we are going to launch the first poll. We'll have 3 polls today. The first one is just to get a sense of who is in the audience. So the question will be, what type of institution are you from? And I now go to the panel. We start with Geeta. Geeta, welcome. Thank you for being with us. I was interested in hearing what does MSDF focus on and in your portfolio of activities in India, and how does mobilizing commercial finance for sustainable development enter into your portfolio? So if you can give a sense of your work, the work of the foundation in India, and why mobilizing commercial capital is one of your concerns. Thank you.
Thanks, Bettina. So yes, I'm with the Michael and Susan Dell Foundation. As the name suggests, this is Michael Dell's personal family foundation. We are a philanthropy. We have a single LP. So, I think it comes with a lot of advantages and a lot of responsibility. But yes, the foundation was set up in 1999 by the Dells with, anchored around the principle of saying, we want to accelerate human opportunity, or we want to create equity in opportunity, which goes back to your point on equity, inclusion, etc. And in order to do that, the focus of the foundation is on children and youth living in urban poverty. So saying, if we are able to make sure that every child and every youth actually has access to an opportunity, to the same set of opportunities or similar set of opportunities as per their merit, then we can actually shape our societies in a very different way. So we set up base in India in 2006. The foundation only operates in 3 countries, US, India, and South Africa. In India, we were set up in 2006. And there are 3 clear program priorities for India: education, livelihoods, and financial inclusion. And I would say the mantras that really guide our work are impact, scale, and sustainability. I think the one thing that the founders and the foundation really swears by is saying measurable impact. So anything that we do, whether it's on the grant side or on the investment side, we should be able to have very clear, tangible measures of impact, both in the short term and in the long term. And what we do or what we support should be able to scale up or have a scalability element. So, we don't need to necessarily be the funders at an at-scale solution, but something that we pilot obviously has to have the element of scalability in it. And it should be sustainable in terms of saying, we recognize it's a very small foundation. The problems are fairly complex and large scale. So what we see should actually have an element of sustainability in it, either with the market taking it over, or the government taking it over, because philanthropic capital is obviously the smallest of the pies when it comes to government and market. And so far in India, we've committed more than $250 million over the last few years. Our reach across our 3 programs is 30 million, and we do have data on impact across this set of target segment. But so the reason I gave all this context in a blended finance discussion is that the fact that impact is front and center for us, the fact that it's a philanthropic foundation and has a single LP, I think, and the fact that our founders and the foundation is keen to have sustainable, large scale impact, tie in very well into the concept of blended finance, saying that we do want to make impact front and center. Anything that we do is, social impact, and therefore, and I'll talk about some of the structures, but we have designed structures which actually incentivize social impact more than the returns, financial returns. Second, because we are a foundation and we are a single LP, I think we have the flexibility to move between different funding tools, whether it's grants, whether it's debt, whether it's variable interest rate, whether it's guarantees, mezz debt, convertible, and because we want to make it sustainable, we are always trying to see how we blend it with other forms of capital. So there are structures where, our facility can sit on top of a loan, where the interest rates can vary based on impact, and we only take care of it, but the loan is, given by a banker or a mainstream investor. Similarly, there are situations where we could, we've also participated in development impact bonds, or we could give guarantees so that other capital can come in. So we can take the higher risk. But yes, I mean, to summarize, impact being front and center, sustainability being the key goal, and I think flexibility in structures really help us design blended finance tools, which again are important from a long-term and scale perspective. I mean, they're difficult to work with, but important for the long term.
No, I think very clear message about the importance of engaging commercial capital to achieve scale, as well as for sustainability, to align sort of also markets based actors around your agenda. Arindam, very different situation with Rabobank. How does sort of engaging a wider pool of commercial investors around your work fit into the scope of what Rabobank does in the India context?
Thanks, Bettina. And just to add to the wonderful points that Geeta made, well, when we look at the blended finance kind of solution structures that we talk of, now it's about blending commercial and non-commercial capital. Now, the biggest advantage for non-commercial capital is first the scale they achieve. And that's, if you look at it from the leverage perspective, that a development sector on its own can never achieve the kind of scale or leverage unless they blend it or work with a commercial mainstream financial institution. Now, we work exclusively in the food and agribusiness sector, and one of the mandates given to Rabo Foundation, this is not the bank per se, where we have soft capital or grant money available, is to ensure access to finance for smallholder farmers across the developing nations, including India. Now, it's one of the toughest nut to crack, and that's something, Bettina, you and the audience is aware of in the developing countries because of the complexities of in the upstream part of agriculture. The farmers are small. It's extremely difficult to reach out mainstream capital, commercial capital on a standalone basis to these farmers and farmer organizations. So what we do is, as a bank, the advantage is we have knowledge of banking, we have knowledge of structuring, we have knowledge of food and agribusiness, being the largest financial institution in the food and agribusiness space, and knowledge of farmer aggregation models, we being a cooperative bank ourselves. So what we do is we pull in development soft capital from global foundations, from grant makers, philanthropic capital, and on the other side, we identify commercial institutions which are focused on the agri sector, which are mission driven and have the ground presence to be able to originate assets which otherwise are deemed to be difficult, because it's extremely important to work with local financial institutions who understand the local economy, and they have the ability not only to originate but to monitor those assets, because the other capital providers, they are located all over the world. It's impossible for them to do the grassroots level origination and monitoring, and that's where organizations like Samunati and others, and India is blessed to have some organization who can front these transactions, because they have the ambitions to go more green, more inclusive. And there are organizations today in India, which was not there 10 years earlier, which are focused solely in the food and agri sector. Now, so that's extremely important. But I would make a comment here, Bettina, to add to the points that you talked about on blended finance solutions. I would say the ultimate success of blended finance products and solutions and programs would be if over a period of time, a certain class of assets is deemed to be bankable on a standalone basis by commercial lenders without the blending. Because, you know, blended finance solutions will be far and few. They are expensive to create. And second is, it takes a lot of time to do that. Each transaction takes anything between 6 months to 1.5 years to structure, because it's highly complex, working with different class of investors, different class of institutions, global organizations. So if blended finance solutions can prove the bankability of a certain asset class, which was earlier deemed to be too risky, too expensive, and we show a way to the mainstream commercial institutions to unlock capital without the support over a period of time, that would be the real success of blended finance instruments. I'll stop here, Bettina.
Thank you, Arindam. I think we'll get back to this question also about, you know, what is needed to really go to scale in terms of standardization, in terms of developing asset classes, not just getting a specific transaction right. Also later in the conversation, but this is a really important point. I also like the fact that you spoke about the importance of connecting different sources of capital, including commercial sources of capital, also for their knowledge base, also for their ability to be close to where origination happens, not just because of the type of capital that they can provide. So there's this sense of scale and also depth of reach in the market that is very important there. I am trying to see if yes, Anil Kumar. So I come to you because Arindam made reference to Samunati. I'm interested in sort of you also presenting where does it sit in terms of the market, of its mandate, and where does it sit with respect to this challenge of navigating across commercial and non-commercial capital in the Indian context. So over to you.
Thank you, Bettina. It's wonderful to be in the panel and also share the work among friends. So I'll pick the thread where Arindam, left, because for me it seems like a relay race now. Arindam has passed on the baton so beautifully, not only in the panel but also in the context of the role that blended finance has played and has been playing in the role of in the life of Samunati, the entity that I take care of. Samunati is an entity that is focused on smallholder farmers with a vision to make markets work for smallholder farmers. And that we are hoping to achieve by making the agri-value chains increase their throughput, operate at a higher equilibrium. And how can we also make the smallholder farmer access the larger ecosystem in the agriculture and the larger ecosystem players in the market, including the pools of capital that are so precious like ESG and CSA pools, to be able to access the smallholder farmer in the Indian context, right? So taking Arindam's idea of further, the beauty of the blended finance into action is what we have seen in Samunati while it is manifesting in our journey in the last few years, right? When we started our journey, we knew intuitively that working with the collectives is the right way to go, given the scale at which the smallholder farmer needs to be included in Samunati's journey. But then we were indeed looking at how do we get a combination of both expertise as well as pools of capital that can catalyze our journey into it. And that's when in 2016, we were actually given a small pool of guarantee for our lending to farmer collectives, which is at that point in time not a private non-bank finance company or a private bank would be doing in the Indian context. And that small pool of capital gave a significant confidence, not only to the internal stakeholders of Sammunati to look at deploying our commercial capital into the farmer collectives, but it also catalyzed some of the larger non-bank finance companies that were lending to Sammunati at that point in time to take a look at the newer model that we were putting together. And I'm talking all of this within 1.5 years of our journey at that point in time. We started in 2014, and 2016 is when Rabobank gave this guarantee, or the small pool of guarantee. While what it guaranteed is actually a small proportion of a total exposure pari passu, the fact that a global entity like Rabo, which understands collectivization, which understands the food and agri-business, and is also bringing that kind of a commitment to the model that Sammunati is building, opened up a newer possibilities for us to collaborate with other players. So it's the blending is just not about pools of economic capital being at the receiving end in a positive way. Sammunati also witnessed that the blending happens at a knowledge level. Blending also happens at the expertise flowing from one entity which has a global experience and understanding into an entity which is building a newer mode of capital. Something similar that happened again thanks to Anindam and Eleanor on the call. Now we are foraying into dark green clean tech as well as specific client segments and newer markets by bringing in the guarantee structures both USDFC and Rabo have put together. And now as an entity, we are much more confident in terms of foraying into newer client segments. And we see this to be an important catalyzing factor, the blended finance being an important catalyst to make newer models and newer target segments receive the support that is so critical during the formative years of any product and solution. I will perhaps talk about the principal agent structure and how at some point in time, without the safety net of a guarantee or a blended finance support, how commercial capital and asset classes can emerge maybe later. But then this is an important dimension that in our own journey as Sammunati, we have been a beneficiary of, Bettina.
Thank you, Anilkumar. What I really like here is, well, clearly the connecting thread, sort of across the various interventions. But in particular, what I like about your story about Sammunati's journey is this incredible innovation drive that you have that has also some really strong tech components, and the support that blending has provided to you, not just to expand reach, expand the scale, sort of really prove the concept really on a significant market scale for your model, but to really expand into these other market segments, to make it possible to develop a viable proposition for underserved segments. That's really, really important. Eleanor, I come to you now from the perspective of an institution that is really familiar with, the use of guarantees, but also the catalytic use of development finance. Can you talk a little bit about the role of DFC at the moment with respect to developing more sort of sustainable development-oriented commercial capital flows in India, as this is something that you are now following closely on behalf of your organization?
Mm-hmm. Yeah, good. Thank you, Bettina. I just want to say first, Anilkumar, I think you stole my talking points, which I'm so glad you said them, because it means a lot more coming from you. We can say it all we want, but it's not until you on the ground taking Aaron Dumb's example of our local partner as our local partner. You said it perfectly. But I will just start by taking a quick step back. I'm from the US IDFC, or the DFC. We are the US government's development finance institution. And I don't want to bore people too much, so I won't spend too much time going through the background of DFC, but we are a new agency as of 2 years ago. For the successor agency to the Overseas Private Investment Corporation, although with new authorities and a much higher exposure limit of $60 billion. We invest debt, we invest equity, we have technical assistance authority, we provide political risk insurance, and then I would say saving the best for last, because it's come up already many times, our guarantee product. And I think we will have a chance to dig into the role that guarantees can play in blended finance later. In India specifically, I think it's one of our highest, I think it might be our highest exposure country. Since we work in India through sort of a partnership model alongside the government of India, investing in those high impact sectors. Since we opened our doors in India, we've invested $5.6 billion there across 200 projects. Our current exposure is $2.6 billion. Over half of this exposure is in the financial sector, so financial institutions. Another huge exposure we have, about 700 million, is the renewable energy sector. So I think these are the two that make the news, and these are our larger investments. This is when we talk about scale. This is where we get a lot of scale. But I will just say to this audience, really our priorities moving forward, in addition to renewable energy and looking at climate change, which is a huge focus under our current administration, is to look at commercial industrial rooftop solar, to look at smaller scale renewable energy interventions. So commercial and industrial rooftop solar, to look at electric vehicles, especially public sector, and three-wheelers, so buses. And then the other big one is healthcare. So how can we look at clinics, hospitals, invest in the supply chain? We just made a huge announcement about our $50 million investment in Biological E, which to expand their vaccine facilities in Hyderabad. So we're pretty excited about that. I also, just for the panel's purposes, I will say agriculture, also a big focus in India, especially as it relates to climate and adaptation. And then the other thing that is near and dear to my heart is our just sort of overlay of gender on all of our transactions. We have a huge commitment to the 2X challenge. We are mobilizing at least 12 billion to 2X qualifying deals by 2025, and hope to impact about 15 million women and girls. This is global. These figures are global. And for the purposes of India, I will just say that I hear all the time in India, well, we don't have that many women-owned or women-led businesses. And through the 2X criteria, we take a much more nuanced look at gender. We look at companies that employ women, companies that have policies that support women, and companies that are producing goods or services that disproportionately benefit women. I will stop there, Bettina.
Thank you. Thank you for reminding us about the 2X challenge. Wonderful initiative, and wonderful to see it really, sort of going to scale and reaching across sectors. I think it's really inspiring, and the success that this challenge has seen, although there is so much more work to do on that front. I want to take note of the fact that the results from the first poll have just come in, and what we have is a predominance of participants from financial institutions. So we can assume a certain level of sophistication, also of understanding of the language, the issues, the models around blended finance. Followed by NGOs and others, I suppose, on exactly the same share, 18.18%, and then also equally distributed among academia, foundations, and government, a little bit less than 10%. We are going to launch also the second question for the poll now, which is, just testing your knowledge, since most of you are from financial institutions, what is the sector where most blended finance transactions happened globally in the past couple of years? So you have a few minutes to think about that, hopefully not Google it, if you don't already know, and see. I come to the panelists with the follow-up question. So we heard from you, Eleanor, now about the sort of areas of interest for DFC in terms of blending in the Indian market. And something that I find sort of is true across countries, across markets, is that blended finance is more typically seen deployed in productive economic sectors. And it's still less common to see it in sectors like healthcare, education, and so forth. Geeta, you spoke about the way in which the foundation is really sort of moving forward with the use of blended structures in like education. Can you tell us a little bit about what does that look like? Yes. What are the challenges, the opportunities in using blending in a sector like education?
Sure, Bettina. So I'm just thinking I'll talk through the three structures we've used and one that is in process in education, and give you real life examples. So one is, and it may not really fit into your definition of blended finance, but I also think early stage high risk equity capital that is put in by philanthropic institutions or even impact funds with the objective of catalyzing mainstream capital comes into the overall category of blended finance. So yes, for the foundation, as I said, urban low income children is a high priority, and therefore in the area both of education as well as skilling and livelihoods, we have supported a few organizations with either seed stage or Series A capital. But these are organizations which had a very clear focus on first generation learners, students from government schools, etc. And then over a period of time, some of these have gone on to raise commercial capital. Some of these have gone on to raise other impact capital, and some of them have also folded up, which is just the nature of investing. So that's one. And this actually, we modeled this around our own journey in urban microfinance, where we had, tried to catalyze the microfinance space in India in the urban area. So we were the first set of investors in, say, an Ujjivan or a Janalakshmi or a Swadhar. And that proved out well. So we try to replicate it in our work in education. So early stage equity, I would say, is one where we both do direct investments as well as invest in seed funds so that they provide catalytic capital to high impact, high quality, but affordable solutions in the space. The second one, and I had referred to this, is varying interest rates based on outcomes. So we had given a loan both to India School Finance Company as well as to Vartana. These are organizations that on-lend to affordable private schools. So we gave a loan, they on-lent to affordable private schools. And then the interest rate, both for the school as well as to, say, a Vartana, was dependent on the assessment and the outcomes of students in those schools. So the better the students perform, the lower the rate. The idea was that we could have actually taken on this product, and I know we've had some discussions in the context of Vartana with DFC also, that, like DFC or Calvert or anybody could be giving a loan to Vartana, a standard loan, and then the MSDF grant facility could sit on top of it, which varies the interest rate so that impact becomes more centered to the discussion. And I think we saw very good results. So when we compare it to the the other portfolio performance of these lending institutions and how the schools did, it was a good exercise. Of course, there is the cost of assessment, and in education that is higher than saying how many micro enterprises supported. But I think it's a fair investment, and the larger the platform one can create, the more we can depreciate some of these investments. So that's the second, where incentives can be, so interest rates and incentives can be directly linked to impact. The third one I would say is development impact bonds. So 3 years or 4 years ago, we participated in Quality Education India Bond, which is the world's largest bond in primary education, along with British Asia Trust and UBS Optimus. And yeah, I mean, I was about to say it's a simple impact bond structure. No impact bond structures are simple, but yes, it's a standard impact bond structure where again, because I think we had some benchmarks on assessments and what can be expected after 1 and 2 years of interventions by strong service providers. One could set the targets. Otherwise in the education space, it is a little bit difficult because data is not that easily available and comparable. But I think that has now, that bond had very successful results in terms of the service providers actually outperforming the targets in the first 2 years. Then of course we've had COVID for the last 2 years, so it hasn't taken its full run. But I think that instrument and that project attracted a lot of attention from the government. And last year we had a discussion with Niti Aayog where they wanted to replicate some of this in the aspirational district, so that some of the government budgets and incentives also get linked to learning outcomes. And I just think like if you're able to, make that shift happen, that will be a significant win because then it becomes part and parcel of work. So yes, that was the fourth one where we are saying, a DIB converting into a social impact bond. And then similarly, we've been having some other discussions with the National Skill Development Corporation on guarantee structures that could enable, loans for skill training or skill financing, as we call it. So again, which is very similar to, the kind of structures Arindam and Anil Kumar talked about. So ultimately it's a guarantee for a loan product. But yes, those are the different ways in which we've used blended finance in the context of education, early stage equity investing, impact bonds, and then loan products and varying interest rates based on impact and outcomes. The one challenge, as I said, in the education space, particularly in the context of India, is assessment data is not easily available. But I think we're getting better at it. Digital and tablets allow us to also make assessments less expensive. But it's an interesting journey, and I do think the sector should continue with it.
I'm really struck by something you just said. Well, first of all, congratulations for innovating at scale in the sector. But I'm struck by something you said about one of the pathways to scale, just sort of really impacting on the overall surrounding environment, is the impact you've had on government. Government also being inspired to take this outcome oriented approach also to pricing some of its own support. We typically think about blending as just having an impact on the behavior of commercial investors, and there's other pathways to market change. So this is it's really interesting. I wonder, are you aware of sort of models you have tested, piloted in the space of being adopted or adaptable in other countries, in other markets beyond India? This is for my own personal curiosity, because you are working towards developing an investable asset class at the end of the day.
Yeah. No, there are very few. I mean, as impact bonds started with social impact bonds, and then DIBs came through. I would say we don't have direct experience where the government has shifted to these models. The discussions we had last year were our first in India. But yes, I mean, I think there's definitely a path to bridge on that count. Like as you said, we keep talking about commercial capital, but if we can influence government, from a low income user perspective, that actually is a much larger pool of capital that you can influence. But
of course,
yes,
indeed. Arindam, let me come to you as well with a similar question, since we're looking at opportunities in specific sectors. Of course, Rabobank has this particular expertise in food and agriculture. But from your perspective of understanding of the overall India market, where do you see the sectors with the highest potential for mobilization of commercial capital through blending, and why? And how do you see the ways into that mobilization across different sectors?
So thanks, Bettina. I think in India, as you rightly mentioned, if you look at the kind of businesses which are an economic activity which generates some kind of income, they are easier, relatively speaking, to get in capital of all hues. We talk of agriculture, we talked about renewable energy, etc. I think these are the sectors which will attract mega funding from different classes of investors, including, structured blended finance solutions. The tough part is going to be education, and I think what Geeta has done is it's like an eye opener for all of us. And I think a lot of work needs to be done on nutrition security, health, now, and on skilling. Now, these are tougher nuts to crack, because if you look at the revenue models, they are much more uncertain than in agriculture or in renewable energy, where it's slowly getting established as an asset class. Tough asset classes, but at least the economic activity generates enough income to be able to make sense of the different structures. But when it comes to education, health, skilling, that's Bettina, just to give a perspective, I would say I don't know whether they have the largest opportunity, but they have the largest need for blended finance capital, because these are the sectors that's going to determine how India is 20 to 30 years down the line in terms of, having educated, having healthy, and having people who are not malnutritioned in any way. Healthy population is always good for a nation. So these are the core sectors, I think, which needs to attract a lot more funding from different sources. Now, having said that, I would just like to stress on one point that Anil made. It's on blending of knowledge, which is as important as blending of capital, because it's not fair for global organizations, whether you're providing development capital or commercial capital, because one thing we forget is that development capital or philanthropic capital can be extremely demanding in terms of impact. Now, to expect a financial institution in India or any other part of the world to be able to, report on indicators which is required by development sector players is not easy. That's one. And second is, it will also be unfair to set up a structure and then leave it to the receiving commercial ground level organization to be able to do all the origination by themselves, because we are talking of new kind of asset classes. So a lot of technical assistance, a lot of exchange of knowledge and capacity building needs to go into identifying opportunities at the grassroots level to be able to work with your partner financial institutions on M&E, on impact assessment and all of that, because commercial financial institutions per se do not have expertise in these areas, and they need to build it up. So it's a journey, and a journey of partnership. And I think most of the blended finance transactions that we have done in India with partners like Samunati, DFC and others, it's a perfect example of what SDG 17 talks of. That's collaboration and partnership, because without that, I don't think we are going to move reluctant capital to the sectors which require them the most.
Thank you. I note that you mentioned not just education, but also healthcare. And Eleanor, just for you to be aware, I will come back and ask whether you have something to offer on this, because you mentioned healthcare as being one of the areas of particular focus for you. But going to Anil next. From the perspective of an innovator, a social entrepreneur, someone who's been investing a lot also in the technology space, sort of what is exactly what is exactly the journey that blending has allowed you to embark on? Sort of Arindam reminding us just now of the importance again of knowledge, of technical assistance, of capacity building, but also more generally of a partnership beyond the blending moment. I think provides a good opportunity for us to maybe get a little bit more granular into how did it happen, how is it happening in the case of Sammonati.
So Bettina, this has been a journey. While finance is one aspect of a structuring, the entire capacity building that happens at an institution level to be able to identify what class of assets that we originate qualify for the for the program, as well as what does it catalyze into, are two important dimensions of any collaborative approach in blended finance. Let me just take an example. When after the FPO guarantee, the second guarantee program that we got is the guarantee on agroforestry. It actually took us 8-9 months to understand what is meant by agroforestry in the first place. Because we were lending to agriculture, we had focus on smallholder farmers, but we also knew that we are not in the business of giving money because there is a guarantee program. Nobody would like to jump from a cliff because there is a safety net down below. It's in the event of fall is why you have a safety net. You just don't lend because there is a guarantee program available. Okay. So it actually took 8 months for us to understand what kind of structures in lending qualify for agroforestry, and that kind of a capacity or an internal capacity that got built thanks to this collaborative approach is a permanent muscle that has got built into Sammonati, so much so that we now have a dedicated team for agroforestry and a dedicated team for climate smart agriculture, both of whom are focused on identifying the assets that qualify these two dimensions. Number one. Number two, there is a lot of entrepreneurial energy that we are seeing in the startup space in agriculture, and Sammonati, being an ecosystem player, does work with a lot of these startups in agriculture. But then at the same time, Sammonati also has quite a few lenders who also look at what kind of assets do we finance. I'll take an example of two such structures. One structure is where we have partnered with an entity that works in making solar pump sets for irrigation, so as to make one non-dependence on the electricity in the rural areas, which is a problem, depending on electricity is a problem. Second, efficient use of precious resource called water for irrigation. Both these coming together in the form of a pump set is what we have supported this entity. And when we put up this program, it was actually a large program. It was about 20 crores of committed line to this entity, each pump being about 4-5 lakhs and being made available to medium holding farmers later on. But then a 20 crore kind of a limit, which is about say $2.5 million approximately, to an initiative that has the dimension of the climate smart agriculture, having guarantee of another entity gives a significant comfort to a mainstream lending entity. And this mainstream lending entity would not have anything to do with the impact or the climate smart or agroforestry, what have you. Mind you, the guarantee is available in the event of a default, but the fact that you have a guarantee in the event of default will give comfort to a mainstream lender to be able to lend to an entity like Sammonati. Finally, Sammonati will have to take care that the event of default does not arise for us to take guarantee as available. Second dimension is it also helps us to develop a specific practice. 15% of our lending and about 12% of our assets are now climate smart compliant. while it was there even before, excepting that now we have the ability to categorize these assets as climate smart assets, thanks to the engagement with the experts on both sides, USDFC and Rabobank, who indoctrinated us to look at all the, all these programs from the dimension of what qualifies, what does not qualify. And the areas that we are focusing on are food loss. We work with some of the cold chain entities and also some of the solar drying interventions. And second one is, of course, the efficient use of clean tech. So this entire lingo of clean tech, preventing food loss, dark green assets. I thought agriculture is green, but I didn't know that there is dark green in agriculture, which is the blended knowledge transfer that the teams are doing to us. But on a serious note, this has built a permanent muscle in an implementation partner like Samunnati, so that at some point in time when the crutches are removed, this will be a mainstream segment within the overall scale of what Samunnati would do. And that gives a lot of comfort to the other commercial lenders on whom Samunnati depends for our wholesale borrowing. Bettina.
Thank you, Anil-Kumar. Something I'd like to emphasize here is also something that is not often in focus in the conversation of blended finance. We have these conversations where we think about, concessional soft capital providers or de-risking entities, and then the commercial investors. And the case of Samunnati for me is also an important reminder of the fact that if you don't build up this fabric of entities, you call it an implementing partner of, sort of intermediaries, sort of enterprises, project originators, etc., that it can actually develop the investable assets. You can de-risk all you want, but you will not have investments to de-risk, and you will not actually have a lasting impact on what I call the fabric of the market. So I also want to pick up this particular point from what you just shared. Eleanor, again, I wanted to come back to you with this question about healthcare, sort of how do you approach in the context of DFC this particular thematic focus. There's something else also that I was interested in as I listened to Arindam and now Anil-Kumar and Geeta also talk about this variety of instruments that can be deployed in blended finance. How do they come together? How do you calibrate and bundle the different tools that DFC has now that it's no longer sort of primarily focused on guarantees, but it really has quite a wide set of tools to make to work together.
Mm-hmm. Bettina, I feel as if you perfectly planted those two questions for me, because there are two things that I'm excited to talk about. On healthcare, I'll just mention our Health and Prosperity Initiative. And I feel like with the US government, everything's an initiative, and maybe I just know the US government, so I can speak to that. But we do have money to put behind it. We're putting $2 billion behind the Health and Prosperity Initiative. That's towards increasing access to healthcare. It's increasing infrastructure, and it includes access to water and sanitation. So we sort of wrap that in there as well. So we have a huge focus on access to health facilities and healthcare, not just in India, although we, especially in India, and that was one of our priority sectors I mentioned in India. In terms of your second question, Bettina, it's something I think about all the time. And I'm happy to be on this panel representing the public sector, because I think it is a unique role that we as a DFI play, having taxpayer money, having access to long-term capital, and thinking about how we should deploy our tools most effectively given the type of money that we have. So with every transaction, we think a lot about additionality. What would happen if we were not there? What can we do that's additional? Our main goal is to mobilize commercial and private capital, and it's to not box out the private sector. So we are very intentional when we ask ourselves those questions for every single transaction. And I mean, I feel very strongly about this, and I'll talk about guarantees in a second, because guarantees have come up so much on this set during the session, and I don't think it's just because I have Arundam and you and Nil on here with me. Education. We do a lot. We deploy our debt product a lot on lending to like-minded financial intermediaries. And I want to talk about the debt product specifically because when we talk about blended finance, we often talk about concessional capital. We're not deploying concessional capital, but we are deploying capital that character can offer, or certain other features that are able to fill gap as that entity is able to raise private capital. So I'm proud of that work. I'm proud especially of our partners, the financial intermediaries we lend to, because of how like-minded they are, and then also the risks that they're willing to take, and the stability we give them with that long-term capital. So I guess a good example is Samanati, and Anil, maybe you want to talk about that at some point. But in India in general, I'd say the entire NBFC sector. NBFCs are partners that are lending. They truly are lending to SMEs. The commercial banks are not truly lending to SMEs in the way the NBFCs are. They're willing to take much more risk. They're willing to do it with less collateral. We've come in, especially these past 2 years, 2+ years, at a time where this predated COVID, the NBFC sector has been so starved for liquidity, and that's really been a strong role we've been able to play. And that is how we're getting money out to social sectors and to SMEs. And as Arundam mentioned, like, we do need our borrowers and our borrowers to have some revenue model, whatever it is. So we're lending to those sectors that are generating revenues. And then I should have saved more time really to talk about the guarantee product, because I think that's the ultimate blended finance product. And we have our 2-time guaranteed partner on the line here with Samanati. We have used that blended finance tool, the risk mitigation tool, to, like Arundam's been talking about, to really get our guaranteed parties, our risk sharing partners, which is a financial intermediary, over the hump of that increased risk perception. And Neil, you've been talking about that specifically with Samanati. Arundam, I liked you asked the question, or you said, how do we get a transaction or lending to a sector to eventually stand alone? And that's really our ultimate goal with that product when we deploy it as one of the parts of a blended finance transaction. Like, we want to work ourselves out of that job. We don't want to be guaranteeing these loans for the next 20 years. We want to be guaranteeing them for 5 or 10 years and get out of there. So I think I'll stop there. Again, Bettina, but thank you. Thank you for those questions that were spot on to what I want to talk about from the DeFi perspective.
So let me just push you just for a second, a little bit further on this issue. You know that data suggests that guarantees are not used as much as they could. So there is certainly, it's not the case of your institution, but they're not instruments that are available to IFIs, also to bilaterals in the space. And I wonder, as you connected the use of guarantees to this idea of working yourself out of a business as a provider of capital that can be blended to the risk. So really establishing transactions that don't require you in the future. Do you have evidence from your experience of an example of sort of guarantees being used in a way that has sort of led to let's say a sustainable change in the behavior of a financial institution, or a particular type of transaction just becoming acceptable, recognized as investable? Sort of, what is the evidence for this lasting impact, specifically of guarantees? If you have an example, if not, no need to be put on the spot. It's just a curiosity.
Yeah, I mean, gosh, we better have examples, right? Because otherwise, what have we been doing this whole time? I don't know, Anil, if this is a good example, but you just mentioned that it took you 8 months to figure out what the forestry sector was, and then you got it. And that was the reason it was forestry sector is because our partner on that guarantee, USAID India, was very focused on that sector. So I think that was a very natural sector for Samanati to be in. But I mean, you can speak to this more than I can, but sort of introduce that as a subsector to what you were already looking at. Bettina, yeah, I mean, not to go too far back, but since we've been offering either the single loan guarantee or the loan portfolio guarantee product, I would not say all of our guarantees were winners, but the majority have been winners and they've been used, and we have not had to sign follow-on guarantees with those institutions. They've gone on to continue to lend to that sector. On what terms, we don't track that as closely as we should. But we do know whether there is a need for a follow-on guarantee. We see if it's been fully utilized or not. And that's our success, is when it has been fully utilized. So yes, we do fortunately have a lot of those in our portfolio, or that have expired out of our portfolio.
Great, thank you so much. We have the results of the second question in the poll in. So the question, as a reminder, was, what is the sector where most blended finance transactions happened globally in the past couple of years? 21% of respondents said energy, 42% said banking and financial services, 21% said agriculture, 16% said infrastructure, nobody said other. So in the past couple of years, it's been primarily energy, actually, followed most recently by agriculture and banking and financial services. So infrastructure is indeed not as high in terms of number of transactions. This was about most, meaning the largest number. It was not about the average size. So once we look at the average ticket size, then it's a little bit different because the scale is very much associated differently with these different sectors. For example, we see different types of transactions in infrastructure compared to energy, certainly compared to agriculture. Agriculture is a sector of particular interest to me, and I've seen it growing in the market. But not necessarily because of smallholder agriculture. So that may be, us getting better at aggregating our portfolios from small scale units of transactions. So it's mostly because of equity investments in large food and agriculture corporates. Now we are launching the third poll question, and I'm also then going to pick up a question from the audience. So the poll question is, how do we take blended finance to scale in terms of volume of commercial finance mobilized in India? What are the key enablers of that? I will also put the same question to the panelists, but in the meantime, the poll is open. And we also have a question from the audience that I'm just going to throw at you, panelists, and you can decide whether or not you want to pick it up. So I'm now going to direct it to one person. The question is the following: with so many unicorns coming up in India and many innovative tech-enabled models, including in EgTech, Agri-Tech, FinTech, etc., that are fetching bumper valuations, do you think that we are experiencing a valuation bubble, or are these models fetching a correct valuation? Does someone want to take a crack at this? Are we sort of overvaluing some of these emerging unicorns? And there are actually quite a lot of unicorns. As many children in the world, including my daughter, would be delighted to see.
Yeah, I can take a crack at it. Not that I have a simple answer to it, but definitely I think unicorns are emerging because technology and data is actually expanding the market size in India. Much larger number of people are coming into the fold. The costs are much more affordable. Whether it's reaching the bottom of the economic pyramid, I won't go there, but definitely the ease of use, the cost of use, the market size is very large. Is it getting fully monetized? Are they, making heavy profits to justify the valuation? Not yet. I guess the hope is they will make it in future. And I would say, like any valuation exercise, it's best justified in the eyes of the buyer and the seller. As fence sitters, it is very difficult for us to comment on. But I think the scope of market expansion is huge. And I guess that's what people are betting on when they give high valuations.
Makes full sense. Does anybody else want to add or comment further on this?
Just one point from my side, just to add to what Geeta mentioned. When we look at the agtech sector, let's stick to the sector that I understand, I have some understanding of. Now, when we are talking of the unicorns in agtech, or the companies which are receiving high valuations in the current market, what we are seeing today is the valuation is not based on the profitability of the day. It's based on the fact that we have a new solution which is efficient, which has never happened earlier because of data and technology, as Geeta mentioned. And second is the potential of the technology or the solution to be able to scale up in a manner which is very brisk, very quick, and it's sustainable. So I think the valuation question can be addressed more from the future potential of the company rather than the balance sheet or the P&L of the current year. Anil, would you like to add something to that?
I was hoping you'll not put me on the spot. But I actually would attribute it to the ability to show some of the working models, Bettina, to the humongously large sector that agriculture represents at this point in time, right? Of course, sustainability is an important dimension, and any proposition that has the ability to scale needs to have an underlying revenue model, underlying business proposition, as well as underlying strength to scale. And agriculture can, in my view, never be fully digital in the next 5-10 years. It would be, since the session is on blended finance, I would say agriculture will be a blended technology, both it's physical and digital. It needs to be blended. You cannot give a smartphone and an app and expect the smallholder farmers to use it like how the urban population uses for Amazon and Flipkart and what have you. You need to have assistance for some time. But there is a huge number of entities and interventions that are showing significant promise of having the opportunity to crack the unmet demand and the potential of agriculture. And if that is reflecting in the confidence of private capital flowing in the agriculture, which is what we are seeing, these are all augur well. These all augur well for the sector.
Thank you. So we move to the third round of questions to panelists. Actually, I'm interested in hearing from you the same thing that we asked through the poll, and then maybe as the results come in, we can reflect on them. So what are the key obstacles to taking to scale the use of blended finance in India at the moment? What would be your top 2-3 priority areas of focus for larger use, sort of more effective use of blending in India? Is it work on the pipeline side? Is it the regulatory environment? Do we need greater availability of soft or high risk tolerant sources of capital? What are the key ingredients? What are the priority ingredients to really scale the market and its mobilization impact? We start with you, Geeta.
Thanks. So yes, difficult to put top 2 or 3. I have a list, but anyway, my priority list would be regulations. It is very difficult to blend 2 different types of capital, whether it's sometimes even foreign domestic, but just the source of capital, philanthropy or CSR with commercial. The second I would say is data sets, because in order to showcase success, in order to catalyze more capital, I mean, just having data on success and what benchmarks of success could look like. I think to the questions you're asking, right? The first time you need a guarantee, does it go away after the second time or the third time? So what does success look like? Because you almost need to sell the concept of blended finance to a lot of domestic sources of capital also, right? So I think the concept, and that really is my third point, is the mindset of domestic philanthropy to seed or sustain more market-based solutions, because I do think, whether because of regulations or the environment, India has worked more in silos, like grant making, versus for-profit investing versus government. And really the blended finance actually breaks down those silos, and all 3 come together. So a little bit of the mindset shift. And I think success metrics and success benchmarks will help in that mindset shift. So yes, regulations, data sets, and mindsets for domestic philanthropy.
Thank you. Can I come to you, Eleanor? So breaking sort of, the usual pattern. With the same question, and in an earlier exchange, you also raised sort of the possibility of sort of a role of a social stock exchange in helping sort of expand the market or the impact of blended finance in India. So generally, I'm interested in also exploring that, but also more generally your perspective on this broader question.
Yeah. So this, like Geeta, I have my wish list, and I'll just mention my wish list first. So my wish list, I'm Geeta, there's no overlap. I'm surprised. Like my wish list, probably our wish lists are long, so there probably is overlap. But my top of my wish list, I would say the engagement of the private sector banks. They have access to liquidity, and I mentioned this earlier. It's my personal opinion. I would like to see them take more risk. I would like to see more, I personally have been very impressed with IndusInd Bank. They have their impact arm. They have a guarantee with us for lending to the water sector. They have a separate guarantee with us for lending to the healthcare sector. Like, I would like to see other banks follow their lead, and maybe they are following it, and I haven't seen it, but I've been very impressed with what IndusInd is doing with their huge amounts of liquidity through deposits from the public. The other thing I would like to see more of is just local institutional investors. And this is something that I personally haven't explored in India, but how can we get that capital mobilized? And I think there is a huge role for us to play there, especially through our guarantee product. The third thing that is just, I would say also, it's an enabler, and I don't know who takes responsibility for this, but I would like there to be more precedents or sort of proven, replicable blended finance models that can be replicated within India. And I usually think of India as the generator of those models for other countries to follow. But in this case, I'm thinking of some examples that we've been engaged with, and specifically the Women's Livelihood Bond. I think I already mentioned it, but just so impressed with their ability to raise, in some cases, institutional capital also to be deployed to ex-qualifying borrowers and to social sectors. So just more of those replicable models to be replicated within India and elsewhere. Bettina, on the social stock exchange, I think, Geeta, you raised it, and if, I don't know where you want to go, Bettina, but I throw it back to Geeta, or I'll hand it back to you to decide.
Sorry, this was my mistake. Indeed, sort of Geeta. Is this something that you wanted to go back to, Geeta, or would you like to add it to your list or spend a moment sort of elaborating on that?
Yeah, no, I would just say, it's a platform that's coming up. I think it can leverage blended finance very well. It's an opportunity area because if we design it well, it can, allow for some of the different types of capital to come together. It can also allow for much larger transactions. So, the data sets and the cost of creating those data sets can get depreciated. I also am conscious of time, and I'm very keen to hear Arindam's and Anil's wish list. So I will just pause.
Thank you. So let me say before I come to you, Anil Kumar, that the poll has come in and we have 44% of people saying that they think that what is needed is more concessional capital available for blending, followed by 22% mandating mobilization targets for financial institutions, then 17% enabling policy environment, and 16% growing the pool of investable projects. So would you agree? Do you have a different list? What's your view, Anil Kumar?
Well, the fact that we are in blended finance, inclusive finance, the fact remains that policy and the enabling environment would certainly play a very, very important role, Bettina. But then from an operator's lens, from the person always in the trenches, the way I look at the blended finance is from three dimensions. One is the blending of the instruments, the guarantee, soft capital, commercial capital, the blending of the instruments as blended finance. The second dimension that I have realized over a period is there is also a blending of sectors, right? Again, the case in point, we would not have seen agroforestry, but for the fact that there is a program that is coming under agroforestry to an extent where now there is a dedicated team for that. The blending of sectors, and now we are also talking about the dark green assets. Now we are also talking about gender-based funding in agriculture. Smallholder farmer funding, and there are instruments that are coming up as green shoots. Now the third one is there is also a dimension of the blending of pricing, right? You start off with a principle like Samunati, having lent a sizable amount and generated a credible track record of the credit history of a particular type of asset. In this case, lending to the farmer collectives. And Eleanor, I didn't know that IndusInd is also one of your clients, but I'm happy to mention here that IndusInd is the first bank that we have gone ahead for a co-lending structure on the FPO lending. And this FPO lending for us started, Bettina, with the guarantee in 2016 from Rabobank. Now you see the answer to your previous question to Eleanor. Are you seeing where commercial capital is flowing into structures that were catalyzed by guarantee program? And this is a beautiful example where we as a small NBFC started a small pilot and had the safety net of a guarantee program. That guarantee program is not existing anymore. We continued with lending to that particular client segment to an extent where now a commercial bank has come to be a co-lending partner. And what it would do to both us and the FPOs is the blended pricing, because now that bank is coming in as a lender, the pricing would go down. So blended finance is just not combination of instruments. It can catalyze flow of resources into specific sectors and also bring in the dimension of lowering the cost across all the players by blending the players.
Thank you for this. And Arindam, you have the last word in terms of wish list, priority areas of focus, how do we really expand the size of the market and its mobilization impact?
Yeah, so thanks for that, Bettina. I think the biggest challenge, not only for India, but globally, is something that Anil Kumar mentioned of, but I'll take a different definition of that, is blending of sectors. I'm talking about the development sector, the public sector, and the private sector. Now, making all three work together is easier said than done. All of them may have very similar objectives when it comes to development, when it comes to, say, sector-based focus like agriculture, nutrition, education, health, skilling, etc. But to stitch up a partnership to be able to unlock capital is another story. So that's why the replicability or the scalability of these structures, it's too early to comment on them, because each transaction so far that we have seen in the Indian market or otherwise is very, very unique with unique participants. So the softer part of making these institutions, intersector players work together is a big, big challenge. That's one. The second wish list is on the regulatory and on the policy front, because if you look at Indian regulations, if you're talking of, development capital, international foundation money, it's being regulated by a certain, ministry of the government of India. You have Indian CSR soft money, which is being regulated by another ministry. Then you have offshore loans, which is regulated by the central bank. You have onshore loans, again, the central bank with different set of regulations. And then you have the income tax, the regulations around that. Then you have regulations around capital markets. Now, to get all of them together to make an exemption for a structure to make it work is very, very difficult. So that's a crying need out there, that if we need more blending, onshore blending in India, we need to have the right kind of policy environment to be able to do that. We don't have that. That's number two. And the third, I guess, would be the challenge to unlock government capital into such structures, because the requirement for government capital, and they have loads of capital which is getting into the very sector that we are speaking of, whether it's agriculture, education, health, skilling, etc. But to make it work with commercial capital, with mainstream financial institutions, we have still not seen the right kind of structures in the Indian market, but it will take champions within the government to be able to make them work with the private sector or with the regulated financial institutions, the private financial institution. And that's a big wish list, is to see one very good transaction out there where the government is an active player in a transaction which is being fronted by an Indian financial institution.
Arindam, we only have 6 minutes, and I want to make sure that if there are questions from the audience, any last minute questions from the audience, they are shared now, so we can address them quickly. But before I go to asking each one of you like a 30-second, what would you like the audience to take home from this conversation? I just wanted to ask you, Arindam, you said a lot of what happens around the existing transactions really depends on the individual players. And, so in a sense, you have to reinvent the wheel every time. You need to have this goodwill. You need to have this, sort of just attitude. Is there any way to, sort of make it something adaptable, to make it travel, to make it something that can be learned? Or do you have a view about how we can sort of learn from what the soft parts of the KPIs?
Yeah, I mean, Bettina, I don't have a very, a ready-made answer or an easy answer to your question, because it's very complicated when you work across sectors and across mandates. So if our development sector, which has a huge amount of experience in blended finance transactions in a certain sector, say food and agriculture, now if you ask them that, look, will you help us create such structures in the education or skilling sector, because we have financial institutions and we have the necessary, kind of channels, but we just need your support to replicate what you have done in the food and agri sector. Then the development sector player says, no, that's not our mandate to move into the other sector. And similar for the private sector or players also, and the public sector players, that the mandates are very, very well defined, and it's very difficult to move them out to another impactful sector where there's a need for capital and that expertise. But just because the mandate is not there, we are not able to do that replication or scale up across sectors.
So we have to work on mandates and on the incentives that those provide also to individuals. We have 3 minutes, and I just want to make sure that we have 30 seconds per person. If you have a last really, sort of quick message that you want to leave the audience with. Geeta, do you want to start?
Yeah, I would just say, the big takeaway is there is a significant scope for blended finance, both in terms of scaling up and in creating impact. I mean, it looks messy, it looks complicated, but I think as we do more and more of it, standard structures will emerge. I mean, today there are templates for PE, VC type of investments, you know, templatized SHA, SSA. I think, I mean, we'll get there. But yeah, I mean, in that, I mean, I agree with her in the more collaborations would help, but I think it has a significant long-term advantage, so we should not get deterred by the complexity of it in the short term.
Great, wonderful, thank you. Eleanor.
Thanks. I think my just parting words are that we, all of us on this panel, everyone in the audience, we have a responsibility to truly think about the tools we have in our toolbox. What is our comparative advantage? What do we bring to the table that's unique, and bring it to the table and work together. And again, like I think about that a lot for the public sector. Like I want to play the role that the public sector plays, not that the private sector plays. It's not my lane. We have a very specific mandate, and it has a very specific role. And I think we all have that responsibility to bring to the table for a blended finance transaction.
Thank you, wonderful. And Anil?
Now, being a beneficiary of the advantages of blended finance, all that I would tell the audience is don't look at blended finance from a very transactional perspective, because the dimension of blended finance has a significant role in unlocking some of the new segments and newer modes of engaging with those new segments permanently. So, I would certainly look at blended finance as a journey for small entities to do meaningful work in the development space, but not always be beneficiaries of that.
Great, thank you, and Arindam, last message.
Well, I would say, I mean, one of the important things to understand that if you want to get into this space of unlocking capital using different pools and different risk appetite, is to understand the nuances of every institution which needs to be involved, and to understand their mandates upfront, so that we save a lot of time and transaction cost in stitching up these kind of relationship. Otherwise, we can waste a lot of time and resources by talking to the wrong organization.
Wrong people, right? Great. So with this, I am delighted to have had the opportunity to be with this panel. Very rich discussion. I've learned a lot. So thank you for sharing so generously of your knowledge, your expertise, but also your ideas, your passion to the topic. I really want to echo this call not to be deterred by the complexity, to live up to our responsibilities, to think about it as a journey, and to really get better at understanding the overall landscape. This is a complex, really worthwhile area of work with very large development dividends. Thank you so much once again, and I just hand the floor back to the overall moderator. Thank you.
Thank you, Bettina, and thank you all the panelists for joining in and taking the time. And Bettina, especially you, thank you for asking the right questions and for such effective moderation. With this, we end this session, and we would request everyone to move to Hall A for another very important plenary session. It's titled Making Finance Work for Women Micro Entrepreneurs, Policy Perspectives and Recommendations for Financial Institutions. We only have 2 more plenary sessions, so I would request everybody to hang on, because these are very important sessions. Yeah, thank you, panelists.
Thank you.